verbal version of the Sunday supplement from the weekend of the 13th and 14th of December 2025. One of my last ones of the year, but not the last one. So I always like to start with a quote, and this week's is: "Home is not where you live, but where they understand you." Christian Morgenstern, German writer and poet. And I'll be going through my normal slots, which is keeping an eye on Donald Trump, Trumpnomics, as I call it these days, the real-time property market, featuring Chris Watkins' great stats apart from anything else, the macroscope, as I go through the 4 largest and most influential things for the UK property market in terms of macroeconomic figures in the past week, and then straight into the deep dive, where today an extremely emotive subject, homelessness, is what I will be talking about. So that quote pertains straight to that deep dive. Homelessness, time of year where we all need to be thinking about things like that. If you're thinking about charities to support for Christmas, I'm a big fan of supporting Crisis and the excellent work that they do in the sector, actively helping to support people who are down in their luck, who are rough sleepers, who are on the streets, who are genuinely homeless. So, as the calendar creeps towards a new year, it's a natural time for us to pause and tackle the biggest challenges that keep SME property businesses from achieving true sustainable growth. For most, this boils down to 2 core areas: laying a bulletproof strategic plan for the next 12 months, and finally cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling short, it's time to switch from doing to leading and truly understanding how your assets are performing. Book in on our next property business workshop with myself and Rod Turner, Thursday the 22nd of January in central London. Links in the notes, and it's tinyurl.com/PBWNINE. Super early bird tickets have only got 5 days left at the price as I'm recording this, so please don't miss out. Please don't have to pay a higher price later on. So first up, I just wanted to say I am continuing. This is an ongoing process of iterating the supplement. I've always been doing that continually, but I'm putting a bit more effort into doing a bit more each week at this time. I'm trying to deliver you guys more for less, which is not easy. Notoriously the most difficult value proposition of them all. I'm some way through a voyage of discovery with AI, and I'm using it a bit differently from many people, the way I see them using it on social media, aside from anything else. They generally seem to be writing posts and then pretending it was them that wrote that post, when you can spot those posts a mile off realistically. I'm trying to harness it to help me become more concise, which I know I need help with, and also lay out arguments in a better and more structured fashion. I am trying. So I've tried a few more refinements this week, and please, thanks to those who've let me know so far what they think. I would love to know some more about what you guys think about this. I love feedback, so please send me a message, drop me a comment on YouTube, on the Facebook Live, somewhere around. Brilliant, thank you. So, Trumpnomics to discuss once more. Highly effective domestic policy this week, followed by geopolitical friction and diplomatic failures. Basically business as usual, realistically, with Mr. Trump in charge. But the tariff-funded Farmer Bridge Assistance Program was announced. $12 billion of one-off support for commodities. Fairly classic protectionism. This generally runs alongside a tariff strategy. Actually pretty conventional in these situations. Of course, the whole situation is not particularly conventional. Hasn't really been pursued with aggression for around about 100 years. Although, it's worth mentioning, the EU, generally speaking, have always pursued a bit of a protectionist policy in general. I think that's why the USA don't like them so much, apart from anything else, and why they've been hitting them harder in the tariff negotiations than they have the UK, for example. They also rolled back standards on vehicle emissions so that they can actually come back to achievable levels from conventional or ICE cars, if you prefer to call them. Deregulation in the automotive sector in the US will now be difficult to reverse, even if, as is possibly suspected, the Republicans lose control of various parts of the administration in the midterms that are coming up in 2026. Then Trump was again involved in a Supreme Court in a case which essentially will end up ruling whether the Donald can do what he wants or not when it comes to removing the heads of independent agencies. He wants absolute power, of course. There's no news there. Then in a Pennsylvania rally, Mr. Trump made sure everyone was clear that the cost of living crisis was all the last guy's fault, and everything he was doing was getting prices down. This is a case of the greatest trick the devil ever pulled was convincing the world he doesn't exist, as people are, with their own eyes, watching prices in the US tick up instead of down, at a rate higher than they otherwise would have done if the tariff interference hadn't been carried out as it goes. And then he ended another war this week, of course, as well, until he didn't. This one was Thailand and Cambodia. Thailand were quick to debunk Mr. Trump's public claims that the ceasefire was back on Saturday the 13th. Oops. The special relationship continues to be in special measures, with, as with little choice to be honest, the MPs in the House of Commons issuing an extraordinary condemnation of the controversial national security strategy, which reads very neutral on the traditional enemies of the West, Russia and China, and quite negatively towards the whole of the EU and the UK. Chilling interference in European democracies. It's hard not to agree, to be honest, demonstrably. The Commissioner of the Met Police also rejected the Donald's claims about crazy crime levels in London. Unusual to see a public spat like that, but then he did start it. Na. Seems suitably mature and befitting of these situations. So a bit of a schism between home and abroad for the US this week. What about the real-time UK property market? Chris Watkin, who I've just actually got off a Zoom with, doing a review of the year, the 49th property market stat show of the year that he does every week. Agent Zero, as I like to call him, as always. I always provide a stripped back summary of his weekly article. So, sales performance and pipeline, 20,900 homes sold subject to contract. An expected seasonal drop from the 22,900 the previous week. Gross sales for 2025 at 1.182 million, 3.4% ahead of 2024 and 12.2% above the 2017 to 19 average. And then weekly net sales 15,700, year-to-date net sales 890,000, still 3% ahead of the 2024 figures. And then the sales pipeline, the pipeline of homes sold subject to, robust at 511,000 homes sold subject to contract as of November the 1st, so 2.2% higher than 12 months before. Price reductions, we only saw 12,800 of them, so the run rate's about half what it's been at some points this year, but that does happen. November and December slows down a bit. So only 8.8% of homes seeing a price reduction in November. 2025 average 13.2, but price cuts are not the way people are generally going at the moment. Chris did share with me that about 6 to 7%, so good job my children aren't listening to this, 6 to 7% of homes have seen a price cut in December, so coming down even more, as it usually does in the run-up to Christmas. The cuts come either in this stock itself gets washed away, or they come for that first weekend in January as a general rule, perhaps for Boxing Day as well. Fall-through rate for the week, 25.8%, a minor increase from the 24.9%, and a little bit above that long-term average of 24.2%. Total stock levels on the market, 1st of December, 678,000, a near carbon copy of the 1st of December 2024, without that incentive though that they had to complete by the 31st of March 2025 because of the stamp duty changes. London has seen notable increases in homes for sale, with 9% more than 12 months ago, 9.96% in inner London. So the market's showing a strong performance in sales volume, continuing to track ahead of last year's figures, but just about. We're in the 0.something% ahead of last year now, but it's the significant narrowing of the price gap. So this is the difference between the asking price, the thing that things get listed at, and then the agreed sales price. There was a huge cavernous gap that opened up, mostly speculated on, Chris tells me, by 50 properties in London in the north of £1 million bracket being released all in one go. That was enough to move the needle. We're not sure whether that was a data glitch or whether that actually really did happen. Perhaps an agent had a crystal ball and knew that the budget wasn't going to be too bad for any homes within the sort of 500k and 1.75 million mark, which is a vast majority of the stock in London, of course. And maybe they knew all of that and they decided that the week after the budget, when everything was good, they were going to launch. I'm not sure. I think they might have been treating that week a little bit like they treat Boxing Day in some agency businesses. So a drop in the price of average price of homes sold in the week, dropped to 352k. So affordable transactions do seem to be driving things in the marketplace at the moment. Jump in the total stock, 742,000, is a key figure to watch, especially with this increase in London listings. Market is resilient though, year to date is strong, clear signs of price adjustment as we head into the new year. Listings were well below the average week 48, about 15% below, so that budget rubber band really hadn't snapped back that hard, which is what I speculated would happen. People will wait for the new year. That snap comes in early January, in my opinion, 0.2% ahead of 2024, so basically the same. I think we'll finish with 2025 being only the second most popular year for listings in the past decade. Seems to be retreating by double-digit basis points per week on last year's figures. But of course, last year, people were massively incentivised because ultimately what they were looking to do was they were looking to complete before the 31st of March 2025, so they didn't have to pay the extra stamp duty. A powerful motivator, of course. So listings down, I think, 19,400, that's what we had. Lowest week 48 for listings in the past 10 years. So we didn't get a post-budget snap. Sold subjects 18,500, 10% below the average week 48. Fairly middle of the pack, really, for every year apart from 2024. So don't read too much into that. There was just that surge in trying to beat the stamp deadline, as I've said. Now, I always give Chris a weekly shout out here. He comes up with fantastic stats on a regular basis. He's a great guy. So please drop him a like, a subscribe, and all the rest of it for all the kind work he does on content creation. His article gets published on the Property Industry Eye website, and the video goes on his YouTube channel at Christopher Watkin. So in Chris's process this week's one, you'll be able to see me on there as well. Okay, let's turn to the macroscope, the RICS Residential Market Report. Growth, growth, growth. Look, laugh, or you'd end up crying. Lots of competition for our third slot, but I had to go with the Zoopla Home Track Rental Market Index because there's definitely some patterns in there that I wanted us to note and talk about. And then gilts and swaps will round us up as always. So, the RICS Residential Market Report, it doesn't really make you go out, beat your chest and seek to buy up the whole of England or any other nations for that matter. It's pretty thin gruel, it's miserable stuff. If you looked at it in isolation with no other info, you'd swear that prices are actually down this year, rather than up a bit nominally, but down in real terms or after inflation. I often speculate as to whether this is because ultimately it's got a heavy London bias. That is, of course, possible, but it certainly reads very, very miserable. So, if you relied on it to tell you what to do next, you'd probably just sell your portfolio. Mainstream press feasted on the gloom, weakest demand in 2 years, sales plummeting, and the pièce de resistance from letting agent today, a 5-year low in tenant demand. Now, just bear in mind, the budget jammed things up a little bit because this is November's report, remember? Right, so on the surface, the metrics do look a bit ugly. New buyer inquiries, net balance minus 32. Agreed sales languishing at minus 23 on the balance. The national house price balance, which is the one that everybody looks at, minus 16. And London hemorrhaging value at minus 44, which is a direct mathematical consequence of the high valuation council tax surcharge, or the mansion tax, as we'll end up calling it for all time, and then the lingering hangover from the autumn budget. The capital is being punished for its asset values, whereas Scotland and Northern Ireland continually and quietly march upwards, oblivious to the carnage in the southeast. But before you panic, look closer, because this is where the amateur sees a crash and the professional sees a mispricing of risk. And that ultimately is how you make money in property. So, the most fascinating data point isn't the sales drop, it's the rental market. Tenant demand, net decline of minus 22, weakest reading since April 2020. Disaster, a slump. Well, not really, but let's look at the supply side. Landlord instructions collapsing by minus 39%. So we're witnessing a market in deep freeze, not in free fall. Landlords are exiting or pausing, spooked by fiscal tinkering, and tenants are hitting an affordability ceiling that simply cannot stretch further. When supply contracts faster than demand, yields don't crash. In fact, they harden, they move upwards. So this is something we're actively seeing play out in the market. Asking rents down in many locations, although the figures aren't necessarily percolating through yet. But I'm in conversation with broader professionals all the time, not the majority of the market, which is still, ultimately with the clock ticking back in the background, 1, 2 and 3 property landlords. So I get my info from the portfolio people like myself. The herd is looking at this minus 16 price balance and seeing 2008, but really they need to look forward at the 12-month expectations, because those same surveyors reporting on the grim November are forecasting a plus 24 net balance for house prices over the coming year. So just as a little reminder how those balance figures work, if we've got plus 24, it means we've got about 65 saying forward and 35 saying backwards. That would be plus 30 actually, so my maths is slightly off there. I do apologise. But still overall pretty positive, 2-to-1 roughly ratio in terms of positivity. Sales volumes, again, the balance is positive as we move into 2026. Well, why? Because the fundamentals of supply constraints haven't changed. If anything, the lack of new instructions, they're down about 19 on the balance, and the dearth of market appraisals. If you're not appraising properties, agents aren't appraising, they're not going to be able to get them on the market ultimately because they're not appraising them in the first place. So that's a balance of minus 40%. So that guarantees a stock shortage when sentiment inevitably pivots. And look, we've been here before. The uncertainty of the budget was a temporary psychological tax on the market. Once the clarity settles, and it always does, the structural deficit of housing stock reasserts itself. Minus 44% balance in London is an adjustment, not an apocalypse. It's just a repricing of yield in a higher tax environment. Well, so what's the play? The casual investors retreat to cash, paralysed by wait and see kind of approaches, but the smart money digests this data differently. We're seeing a window where vendors are motivated, competition is thin because of inquiries are down 32% on the balance at various agents. You've got fewer elbows in the ribs at your viewings, and that long-term trajectory remains upwards. Don't mistake a pause for a pivot. The data shows a market taking a breath, constrained by affordability and policy shock, but coiled for a recovery. The 12-month outlook is bright for a reason. Buy value, add value, manage the risk, and ignore the noise. Okay, on to growth. You remember it, in theory, the promises, the pledges, the cutting of regulations to achieve more growth. The misery guts like me after the last budget saying we'd be lucky to hit 1% growth this year, and my number was 0.75 or so. A mere few months ago, I was lamenting being too miserable as growth numbers had significantly outperformed what the PMI suggested. Well, we're having our correction now. The JLR cyber attack is still taking a lot of flack for it, and rightly so, but we have seen a bit of a rubber band effect there. And then the reality is that the budget speculation was damaging to the economy this time around, so damaging, and I really hope the incumbents learn their lessons. I doubt they will, so instead we better just hope that taxes don't need to go up again next budget. Numbers are about 60% likely that taxes won't need to go up again, but not exactly a shoo-in. Okay, what about the meat? Well, we were down 0.1% for October when it came to growth. The second monthly decline in a row. Over the last 3 months reported on, August to October, we are going backwards. Now, we define a recession in calendar quarters, not just a quarter. So August to October is not a calendar quarter. So we're not halfway to a recession because ultimately we haven't seen a recession figures for Q3 2024. It's falling at kind of the perfect time in many ways. But I do like to look at recessions over a 6-month period, even if they're not in calendar quarters, because the calendar quarters are just arbitrary. If the economy is contracting, it's contracting. So let's see what happens. So services up 0.0%, and basically we rely on services to drive the economy. So if they don't go forward, everything else will probably drag it backwards. And that's what happened in October. October alone, services dropped 0.3%. That is really significant. Why? Well, a massive pullback in business services for information and communication. Why? Because of the budget. Back to our root cause. And then we've been waiting for construction reality to match the miserable PMIs we've been getting out of the construction sector. And don't forget November's PMIs, much, much worse. This is October's growth figures, whereas we've already had November's PMIs. Down 0.6 in October and 0.3 for the quarter. Production was hammered by the cyber attack in the quarter. And whilst the rubber band snaps back, it's not the same as us catching up. That damage is permanent and will stay in the figures until it drops out in about 10 months' time for October 26's growth figures, or September 26, I should say. Now, NISA, the National Institute of Economic and Social Research, do a bit of a growth nowcast when the figures come up. I've critiqued them a number of times this year for being too optimistic, but they have November down as minus 0.1 as well. The PMIs were positive, so for once it might be a bit bearish from NISA, but we can't ignore the budget dampening effect for November. I hope they're wrong and instead we print a plus 0.1. Their track record isn't great, but then this stuff is particularly hard month on month. Black Friday, for example, only just squeezed into November's calendar this year, whereas Cyber Monday was in December. So that itself will have an impact, just as an example, compared to a normal November. And these things, little bits are going on every month, all parts of the year. And of course, when you're talking in 0.1s, it doesn't take a huge amount to move that needle. So the graph is just trending down and down and down in terms of growth from April, I'm afraid, when that employer's national insurance kicked in. All that extra money and the decrease in the allowances that employers would get before they had to pay, or decrease in staff wages that were needed before employers' nationals kicked in. So business rates reports are coming in from individual businesses, and in spite of some respected commentators, Dan Needle, for example, saying that no business would see more than a 15% increase in rates. Many a story is coming in from pubs, retail and leisure, where COVID discounts have now expired, showing increases of 25 to 70% on their business rates bills. Haven't seen higher than 70 yet, but there's been a few things going on simultaneously that all kick in next April, where people are expecting suddenly this huge drop off in inflation. Energy prices will help a little bit, and so will base effects. But I see the flip side, where more price hikes will be needed to pay for the higher tax burdens one way or another. Primarily on premises, but don't forget national living wage plus national insurance contributions will put staff costs up another 5%, which is not congruent with a 2% inflation world. Inflation is embedded within the system, which is what the dissenters at next week's Bank of England rates meeting will say when the rate is cut. I'm going to plump for a 6-3 vote in favour of a cut, but the consensus says 5-4. The growth figures will offer more reasons to cut, of course. There will now be a real cause behind what the doves have been saying for more than 2 years. Rates are too high and they're stifling the economy. We're now at the stage where GDP has fallen every month since June, 4 months in a row. It's the first quarterly print with a row backwards, but it will take some growth to snap this off, and it's unlikely to come in November's figures as stated already. December, difficult month to predict. What I'd say in front of my eyes when I'm out and about at the moment is that many venues that you'd expect in the build up to Christmas to be packed out were instead very quiet indeed. But the individual variants of one man's observations are not enough to build an economic forecast on the back of, unless you claim to be that clever like Gary Stevenson does, of course. But anyway, my gut feel is that people are saving for the big day because the cost of living crisis is still biting. The Home Track Zoopla rental market report, then December's insights. Well, instead of a drop in asking rent, Zoopla is seeing 2.2% growth, down from 3.3% 12 months ago, and well below average earnings growth, which is good, although earnings do get subject to tax. Of course, let's not forget that. Demand down 20% year on year, supply up 15% year on year, but this is from some fairly extreme 2024 figures, remember, compared to, say, pre-pandemic normality. Was that a thing? It felt like a thing. Can't really remember. Anyway, why did this happen? Well, as so often, Zoopla turns to migration to explain, and rightly so. The huge drop in net migration is a huge factor, just as I spoke of it on the other side as a huge factor on the way up. The numbers are 78% down from June 23 to June 25. First-time buyer mortgages up 20% in the 9 months to September 2025. Also helps supply, as they ultimately usually leave the rental market and enter the owner-occupier market. 17 days let time is also up 20% from a year ago, easing market pressures, limiting future rent increases. This is readjustment. In the real world, the larger landlords seem to raise rents a fair bit more than the figures were suggesting, but then overshot and are cutting rents relatively aggressively. Quite a few are reporting 7.5 to 10% cuts to me in their asking rents compared to 12 months ago. Rent growth remains strong in the cheaper areas where affordability is not choking the market. The North East and the North West continue to outperform, plus 4.5 for the North East, plus 3.2 for the North West. Northern Ireland rents are still rocketing forwards at plus 11%. Zoopla still has London asking rents going upwards at 1.6%, but then what's being asked and what's being agreed might well be two different things. London's supply of rental units up 6% year on year is a lot smaller than the broader 15% more units figure, as weak yields down there force sell-offs as there are limited options other than weak returns or even putting money in each month in order to keep hold of the property, which is a bit like the old days, but without the capital growth at the moment. So what are Zoopla's expectations for 2026? A 2.5% rise in rents. That figure that leapt off the page though, 31% of homes for sale on Zoopla in London were former rentals. Now if they don't sell, they might just be rented again. It's a rock and a hard place at the moment because I don't believe the amateurs have a great handle on the market, and they think sell rather than think sell at this specific price because the market is weak. I've said many times before, we all make decisions every day on the future of the market. It's just that with so many landlords, the default position is hold at all costs, which is a position I used to hold myself but happily switched from back in 2021. And it was a great decision to do so at the time. Okay, we safely made it to the gilts and swaps. The 5-year had a flat week for yields, but that was only strengthening from the open of 3.957 to a peak of 4.04 early on Wednesday, only to drop back again on the back of the weak growth figures which were released on Friday. However, the consensus miss on growth, which was significant because the assembled nodding dogs had predicted 0.1 growth, instead we got 0.1 contraction, so they were 0.2% out, but it did not have the normal impact that would have on yields when you get a downside miss like that. It didn't suppress them dramatically. It barely moved the needle. Now, I often conclude this in these situations. When the market doesn't do what you'd expect, be careful. It looks like a sign to me that the market is hardening a little and yields may instead be trending upwards. I'd suspect it was because of the speculation of the Bank of England committee vote would be close. So, either way, it cements a position I'm taking for 2026. I think between right now and Q3 next year, we'll see 3 cuts in the base rate, including one this week. I still feel as though it would be tough to get too far below the natural rate, which is speculated to be at around 3.5% in this economy. However, the economy might need more help. It really won't take much to go wrong from an external perspective for us to need some boosting on the monetary policy front. Not a black swan, more of a black speck of dust, if you will. Great news, eh? Well, let me finish. I don't think this will have much of an impact at all on 5-year mortgage rates specifically. 2 years should come down a bit, maybe even 0.5% or more like a 1/3%. But 5 years I don't think will go down much at all. So we've been benefiting from this 35 basis point discount between the gilts and the swaps for some months now. That might decay, reverse, etc. We've got no historic right to this discount from the swap market. And then if mortgage demand goes up and rates go down because some confidence returns, well, that's going to change the supply and demand in the swap market, isn't it? So the discount might swallow up some of that slack as well. Now, I hope we might see 5% with no fee kind of rates come through. It's only about 0.25% if we do get there, as the best buys from Paragon or similar of the world. But I really dare and hope for better than that in terms of where pricing will be. So what? Well, don't sit there waiting for rates to get better. Today's rates already reflect some very fair pricing, bearing in mind the broader economy and the cost of the debt. You'll only sit and be disappointed. Set, forget, move on to the next project. Thursday's 5-year closed on the gilt yields at 3.977 compared to a swap rate of 3.65. So the discount does seem to be narrowing somewhat already with its second week around 32 basis points. Keep your eyes peeled because 1 month ago, swap rate was 3.528 on the 5-year yield wise, and then 1 year ago it's 3.823. I'm going to carry on watching this one. What about the 30-year? Well, I posted some research this week around the moron premium after a new paper came out by the IPPR, the Institute of Public Policy Research, suggesting we are spending £7 billion more per year than we need to because we're inefficient on our debt management. Now, I personally think that figure's at the low end, right? The 30-year yields, gilts, sharpened this week after the 5s really didn't move much at all, as we've already discussed. The 30s opened at 5.211 and ended back above 5.25 again. They closed at 5.271. Up 6 basis points, yield curve gets sharper and steeper again. Still no long-term confidence in the UK economy. Are the incumbents in for the long term? I think we all think they're not, but it's hard to split hope from calculated analysis, although the polling numbers do speak for themselves. So that brings us once again to the diving hire shop so we can mask up, get the scuba kit and dive deep. The confluence of reporting here is significant. The Ministry of Housing, Communities and Local Government released their national plan to end homelessness at a time when temporary accommodation will continue rocketing thanks to the Renters' Rights Act. The irony was not lost on me. And then both Crisis and Shelter released timely reports on homelessness. Now I must kick off with a mini rant. Shelter upset me this week. I was making a charitable donation to support a bit of pro bono work that a friend of mine was doing. The charity in question, if you're interested, is Acorn Children's Hospice, Acorns. So noble work. I don't think anyone would disagree with that. He told me just to donate to them directly, no need to go through his website or anything like that. So I just Googled it. And the first result, sponsored link, I note, was Shelter. So trying to redirect or hijack my very specific search query for a donation to a different charity. I did think, I wonder if that's known about and seen as a good use of funds raised. Speculating to accumulate, of course. Certainly very businesslike, I'm sure we'd all agree. Anyway, after that segue about the organisation that leaves a nasty taste in the mouth, above all others that come under the badge of lobby groups, onwards we go. Homelessness. Persistent failure of the UK housing market has advanced beyond a technical supply-side inadequacy. What was once excusably framed as a market failure, a simple shortfall of units, is now unequivocally a catastrophic social failure, culminating in an unsustainable annual taxpayer burden estimated at 2.8 billion, with the numbers looking more like 4 billion by the end of this decade, if not more. The data underpinning this judgment is clear and chillingly demonstrates the accelerating scale of the crisis. So the statutory homelessness data says the system is overwhelmed. A family is being made homeless or threatened with homelessness every 5 minutes. The relentless rate of crisis entry highlights the fundamental instability embedded within the current economic and landlord-tenant framework. What about misuse of temporary accommodation? Well, fiscal and social costs must converge, and they do converge sharply in temporary accommodation. There's the egregious misuse of unsuitable settings, 2,070 households trapped beyond their 6-week statutory limit in unfit B&Bs. The cost to the public purse for managing this crisis is escalating rapidly, with taxpayers paying the price of failure as temporary accommodation costs are skyrocketing. The government is onto this part specifically. And then what about the hidden cost? Well, beyond the visible statistics, extensive research reveals the invisible depth of this crisis. People sleeping in cars, staying in sheds, in garages, sofa surfing with friends, family, or even strangers because they've got nowhere else to go. These experiences are precarious and transitory, with 40% of participants in one study reporting moving more than 6 times within a typical month. 40% of homeless people doing that. So this hidden reality results in stark social outcomes, impacting 81% of participants' mental health and 72% of their physical health, creating long-term dependencies that ultimately increase the state's future welfare burden. So the intersection of fiscal policy and landlord economics has created this untenable situation, and while legislative changes such as the introduction of the Renters' Rights Act to end Section 21 no-fault evictions are deemed necessary to stabilise the private rented sector, that's the line that the government have been fed, of course, all they're doing is addressing symptoms. They're not getting into the root cause. They're not addressing the underlying supply catastrophe. And then the government's committed to a £3.5 billion investment over the next 3 years to combat homelessness and rough sleeping, recognising that this scale of societal damage requires collective responsibility. However, the immense annual expense on temporary accommodation, the very definition of paying for a system that's broken down, underscores that our current policy approach is fiscally punitive. Until we can meaningfully increase the supply of genuinely affordable homes and ensure robust collaboration between public services to prevent crisis entry, this exorbitant £2.8 billion bill will remain the quantifiable price of a social failure we can no longer afford to ignore. Is there a realistic plan for that? Well, I haven't seen one with political support, that's for sure. The current financial hemorrhage due to temporary accommodation is analogous to having a roof leak so badly that you spend more money on constantly replacing buckets than you would on installing a whole new roof. It's an economically irrational response to a profound social problem. So, it's people selling up, right? The analysis that the exodus of private landlords, specifically landlords selling up, is the single greatest driver of statutory homelessness. That's not merely anecdotal. It is a critical economic vector confirming the rental safety net failure. So this is a policy-driven supply contraction, right? The private rental sector, the PRS, is the largest source of flexible housing in the UK, but fiscal burdens and legislative burdens have driven capital away from this asset class, creating a profound supply shock. The legislative context is crucial. The recent introduction of the Renters' Rights Act, notably ending those Section 21s, as I say, badged as necessary reform, but there's an undeniable increase in risk, effort and administrative friction for landlords involved. What does that mean they want? Better returns if they're going to stay in. But this shift combined with unsupportive fiscal conditions, so for example, new taxes, extra taxes on rental income in the recent budget, for example, that is incentivising exit over and above retaining the assets. If landlords sell rather than re-let, the housing stock is sometimes out of the rental market altogether, shrinking the available supply for the most vulnerable. Sometimes it's just bought by another investor, of course. What about the rental safety net and its failure and the mathematical link? So what's the concept of this rental safety net failure? The systemic collapse of housing stability, where the PRS, that primary source of accommodation, can't absorb household shocks anymore, pushing all displacement directly onto the statutory safety net, aka the local authority. So what about supply loss as the input? PRS is contracting. That pool of affordable, accessible housing for low-income and vulnerable households diminishes. It immediately impacts the rate of prevention. And the government's own strategy aims to increase the rate of prevention to protect thousands more households from homelessness, acknowledging that the current prevention mechanisms are insufficient. Statutory system overload. Every council that exits the PRS into homelessness adds to the overwhelming demand on local councils. We see this manifested in that chilling statistic I already mentioned, a family being made homeless or threatened with homelessness every 5 minutes. Constant severe rate of crisis entry, a direct consequence of the loss of private rental stock. What about the TA bottleneck, temporary accommodation bottleneck? Well, this reduced supply and high crisis rate create an inescapable bottleneck at the final stage of statutory assistance, temporary accommodation. Not enough private homes, not enough social homes for families to move into, therefore household gets trapped in TA and that spirals upwards. And this directly explains that record figure of 132,410 households now reliant on emergency accommodation or similar. This will probably be 200,000 by the end of the decade, most of the analysis believes, and certainly I believe that. Not a coincidence, it's a mathematically verifiable result of supply-side economics. Shrinking supply in the PRS forces households into already deficient statutory system, results in skyrocketing costs of temporary accommodation, where taxpayers effectively pay the price of failure. So, the attempt by the government to counteract this by boosting the supply of good quality temporary homes, backed by £950 million, a recognition of the desperate need to manage the influx, but it's not going to survive at a foundational level the deficit that's driving this crisis. Until the underlying economic incentives are adjusted to stabilise and grow the affordable PRS, or until the £39 billion investment in social and affordable housing to build 1.5 million homes, materialises, then the rental safety net will continue to fall, and that 132,410 households in temporary accommodation will just remain as a tragic demonstration of failed housing policy. What about the freezing of LHA rates, a concept that the Labour Party are ideologically married to? Well, the discussion around the local housing allowance and housing benefit is fundamentally an examination of fiscal neglect, where policy failure at the national level directly creates catastrophic costs and social chaos at the local authority level, and they often end up paying more because they haven't got this alternative. So the core mechanism of failure stems from the economic absurdity of maintaining a frozen or deeply constrained benefit rate in a soaring private rental market. The consequence of this policy divergence is demonstrably equivalent or evident in the resulting statutory homelessness crisis. This is one area where the lobby groups and the more well-meaning charities and the housing providers all agree LHA rates must be unfrozen. What about the mathematical transfer of failure? Well, remember, LHA/housing benefit is supposed to be the primary preventative financial safety net, ensuring that low-income tenants can retain their homes in the PRS. When the LHA fails to cover even the lowest quartile of market rents, that net disintegrates, leading to 3 direct and costly outcomes. Number 1, forced eviction and crisis entry. When LHA ceases to function as a viable subsidy, tenants are rendered immediately unattractive to landlords or are forced into unsustainable arrears, resulting in evictions. This fuels the relentless crisis rate where a family is being made homeless or threatened with homelessness every 5 minutes. I say once again. Statutory homelessness escalation. Well, every failed prevention attempt which the inadequate LHA system guarantees pushes the household into the statutory homelessness system. Local authorities are then legally obliged to house them. The sheer volume of this policy-induced crisis necessitates government action aimed at increasing the rate of prevention to protect thousands more households acknowledging current failures. What about the fiscal burden on local authorities? The inability of the central benefit system to provide an adequate payment transfers the financial burden entirely to councils in the form of emergency accommodation costs. We see the direct result of this transfer in the skyrocketing costs of TA, while taxpayers are paying that price of failure. The evidence of this catastrophic overload is quantifiable. The government has been compelled to provide an extra £50 million of funding in year through the Homelessness Prevention Grant to local authorities. Nearly £1 billion is being injected through the Local Authority Housing Fund simply to supply a boost to the supply of good quality temporary homes, recognising the system is fundamentally reliant on emergency measures due to the failure of upstream prevention mechanisms. Then the ultimate sign of this policy breakdown is the severe and unlawful conditions faced by the displaced. The benefit freeze contributes directly to the fact that these 2,070 households are trapped beyond their 6-week statutory limit in unsuitable B&Bs. These locations are often unfit, often only offering one room, no cooking facilities, fundamentally compromising the well-being and future prospects of vulnerable families. And if you've got no cooking facilities, it doesn't help you spend less money on food when you're skint, let's face it. So LHA in its currently constrained form has thus transitioned from a protective benefit to a mechanism for institutionalising homelessness. It's no longer an adequate subsidy, it's merely an accelerator that ensures vulnerable tenants transition swiftly from private tenancy failure to public sector dependence, dramatically escalating the cost and complexity of the resulting social failure. This benefit structure is a bit like operating a rusted firewall in a spreading blaze. It's not containing the problem, it's merely conducting the heat of rising rents directly into the weakest parts of the public housing infrastructure. And then the current financial architecture of homelessness provision is fiscally catastrophic, representing the ultimate quantifiable evidence of policy failure. The taxpayer bill for managing this crisis, primarily through emergency sheltering, will go well over the 2.8 billion that it already costs. This exponential rise in expenditure proves that the system has transitioned entirely from prevention to punitive crisis management. So what about this 2.8 billion black hole, the price of failure? Well, it's more than a cost, it's a financial measure of the housing system's systemic breakdown. The government itself admits that taxpayers are paying the price of failure as TA costs skyrocket. The enormous outlay is necessary because the preventative mechanisms upstream, like the local housing allowance as already discussed, and sufficient affordable housing supply have collapsed, which basically guarantees ongoing homelessness. So to manage this crisis influx, central government has to be forced into massive emergency interventions. Bolstering housing supply, that 950 million we talked about earlier, boosts that supply of good quality temporary homes. It's an acknowledgement that the volume of need exceeds current capacity, necessitating a huge capital outlay merely to shelter the displaced. And then this emergency mitigation, the extra 50 million of in-year funding required through the Homelessness Prevention Grant. This grant is focused on prevention, demonstrating that local authority budgets are so strained that they require emergency central top-ups to perform their most basic statutory duty. So this self-defeating cost transfer, bankrupting local government, well, the true fiscal poison lies in the self-defeating cost transfer mechanism. The economic reality is clear. Inadequate reimbursement from central benefit systems, like DWP, via housing benefit, for emergency accommodation forces local authorities to shoulder the difference. A disastrous circular economy. Central policy failure, inadequate LHA rates, supply stagnation drives a massive demand for TA. Local authorities have to meet this statutory duty, running up astronomical bills in the process. That's your 2.8 billion and rising. And then if central funding fails to match the actual market cost of provision, especially given the high rates charged for emergency placements, councils are left with hundreds of millions of pounds deficit. Angry circles do not get a lot more vicious than that, folks. This system is inherently unstable, fiscally reckless. Expenditure is not an investment in housing stock, it's just a continuous revenue drain. Often this is unsuitable emergency housing like B&Bs. The government really need to simplify funding for councils and end bidding processes, right? It's an implicit recognition that the administrative complexity and insufficient funding models are crippling local delivery. By funding failure at an exponential rate, the central state is effectively exporting its policy negligence to local balance sheets, ensuring that housing costs erode the capacity of local government to deliver other essential services. This cycle turns the massive 2.8 billion cost into both a social tragedy and a significant driver of local insolvency. This situation is a little bit akin to a company that earns 100 million in revenue but spends 200 million fighting constant lawsuits caused by a faulty product design, all while refusing to fix the original design flaw. The money is spent, but the problem and the debt only keeps on growing. So what about this launch of the National Plan to End Homelessness, backed by a £3.5 billion investment over the next 3 years? Well, it's just government acknowledgement of this catastrophic social failure that we're witnessing. Now, if you use the critical lens of property economics on this, the plan reveals itself to be predominantly a sophisticated crisis management measure rather than a genuine structural solution to the fundamental supply deficit driving statutory homelessness. Possibly because at the prices currently, with the MPs in Parliament where they are, there isn't a solution at the minute. But anyway, what are the core targets? Well, addressing symptoms, not causes. That's a problem. The plan sets out 3 key pledges to be achieved by the end of this Parliament. Halve the number of people experiencing long-term rough sleeping. End the use of unlawful B&Bs for families and increase the rate of prevention to protect thousands more households from homelessness. These targets are undeniably critical to restoring dignity and mitigating the most visible and cruel aspects of social failure. The focus on long-term rough sleeping, including the £124 million supported housing scheme and the £15 million long-term rough sleeping innovation programme, addresses these cohorts with the most complex needs. However, these targets almost exclusively focus on mitigating the consequences of housing failure rather than dismantling that primary driver. Now, the primary driver is the collapsing supply in the private rental sector. Why? Well, an exodus of landlords selling up, as I've already established and talked about over the past 12 plus months. What about an assessment of proposed solutions versus the supply crisis? The solutions proposed within the plan are geared towards improving system efficacy and managing flow, yet they largely bypass the market mechanism required to solve the supply crisis. So what's the proposed solution? What about the duty to collaborate, or DTC? That requires public bodies, prisons, hospitals, social care, etc. to work together to prevent homelessness. So, for example, you can't anymore, or they certainly want to halve the number of people who, out of prison, first night, quite regularly people are homeless. What will be the impact on the PRS supply or the statutory homelessness driver? Well, the DTC should excel at managing the risk of homelessness from public institutions. It fixes internal state failures, but provides no mechanism to increase the overall availability of low-cost, secure housing stock, which is the necessary safety valve for the collapsing PRS supply. Long-term rough sleeping innovation programme, so 124 million funding councils to develop fresh solutions for complex needs, providing stable housing, supported housing scheme. Crisis management, well, this ultimately targets the most chronic and visible failure, focusing on those who have spent years on the streets. Whilst vital, it is dedicated to treating specialised complex needs and does not alleviate the general systemic pressure caused by evictions from the mainstream rental market. What about this 950 million local authority housing fund then? Well, dedicated to boosting the supply of good quality temporary homes. Ultimately, it's crisis management. Again, it's the most explicit admission that this is crisis management. This funding is used to acquire emergency or interim housing, not long-term, genuinely affordable housing that would reduce the need for temporary accommodation in the first place. It's a high-cost solution to accommodate the record 132,410. So, structural versus crisis management. A true structural solution to the UK's housing failure must address the fundamental market imbalance. The government is investing 39 billion, this biggest boost to social and affordable housing in a generation, aiming to build 1.5 million homes. We know that won't happen, but they're having a go. That 39 billion, in context, it's about doubled, but then inflation has taken back about 30 to 40% of that compared to what it was. It's also gone a bit longer term. Rachel Reeves hasn't done the worst job there. But some research really suggests you're going to need more like 150 billion a year, or at least 100 billion a year, if you were going to really build social homes. The trouble is, social and affordable are lumped together, and there's a huge difference. Affordable rents are not always affordable. Apart from anything, 80% of London market rent is still extremely high indeed. Social rents tend to float around between about 50 to 65% of market rent, much more palatable for particularly low-income households. Now, the national plan itself, with the £3.5 billion investment, primarily functions as an emergency overhaul of service delivery. It wants to make homelessness rare, brief and not repeated by focusing on prevention at the service delivery level, such as that duty to collaborate. While the government has also passed the Renters' Rights Act to end Section 21, which was packaged as this crucial reform to stabilise the PRS, no comment, the plan's accompanying investment is primarily channelled into mitigating the crisis rather than incentivising the rapid expansion of affordable PRS supply, which is the critical missing piece. Remember, these reports are produced by people like Shelter and Crisis and the government. They're not being produced by the private rental sector or any lobbyists for the private rental sector, aside from anything else. So, in the real world outside of the government reports, disincentivising housing providers means that a functional market relies on first-time buyers to sort themselves out and vacate rental units at a rate fast enough to ensure there continues to be enough supply to pick up the market failure from the social housing system that is a shadow of its former self. still expensive crisis management, ultimately. It's designed to plug immediate leaks, treat severe trauma, but without the sustained delivery of the promised 1.5 million affordable homes. It's not going to solve this structural deficiency, and the collapse of the accessible private rental safety net that is driving a family to be made homeless or threatened with homelessness, I say once again, every 5 minutes. And this current economic environment demands an immediate, decisive and integrated Propenomix style intervention. What we need is a shift from expensive crisis management to structural market re-engineering. Will we get it? Well, we've demonstrated failures in prevention, supply and finance, so there needs to be a tripartite strategy for ending this crisis, which has got support from the lobby groups and from the honest actors within this marketplace. So re-engage the private rental safety net, right? Fundamental policy error has been allowing this to collapse, and it's going to continue showing itself as collapsing as time goes on, the more time nothing is done for. Continuous skyrocketing of temporary accommodation, taxpayers paying the price of failure. What do we need? Immediate LHA uprating. The minimum viability floor. It must go to the 30th percentile. Really, ideally, back to the 50th percentile. We need genuine market rates, competitive market rates. An effective rate would reduce the dependency on local authorities, curtailing the spiralling cost of temporary emergency housing. What about targeted tax relief for retention? So the government will stick to the party line. They think they've done a great thing when they cite the Renters' Rights Act, putting an end to Section 21 no-fault evictions as a necessary tenant protection. Almost sounds like a sponsored ad or something, doesn't it? To counterbalance the resulting increased risk and administrative friction that causes landlords to sell up, the government has got to incentivise stable long-term PRS engagement. Targeted tax relief, structured around duration of tenure and maintenance of affordable or LHA rate rents, must be implemented to retain existing stock and stabilise the market that is currently hemorrhaging supply. Remember who these words are coming from, folks. Now, what about institutionalising affordable housing? We need that supply transformation. This 39 billion over 10 years, it's frankly not enough, and we're not going to build 1.5 million homes with it. It needs to be fast, it needs to be reliable, and it needs to be decoupled from the political cycle. So, what's the prescription? A new institutional model, leverage of patient capital. It's a lovely concept, this patient capital, but it is out there. Ultimately, long-term institutional investors are extremely patient, right? Pension funds, sovereign wealth funds, which is an external concept, the sovereign wealth fund, of course. It's not being suggested in the crisis paperwork or the shelter report that's being analysed here. But this is what we need to attract. A purpose-built, regulated, affordable rental sector. Could be facilitated through REITs, real estate investment trusts, similar vehicles. They could offer stable returns in exchange for adhering to affordable rent caps and long-term security of tenure. Focus on housing outcomes, not just units, right? The institutional approach must prioritise the creation of stable, supported housing, recognising that housing outcomes are deeply linked to complex needs. Research conducted through programmes like the systems-wide evaluation of homelessness and rough sleeping highlights the importance of supported housing and its interaction with the wider system, noting challenges like declining provision and fragmented funding. The new model must provide secure funding and standardised quality for this critical supported stock. Prevention mandates then, from collaboration to accountable outcomes, and this proposed duty to collaborate once again. So public bodies have got to work together to prevent homelessness. Remember, prisons, hospitals, social care. It's a welcome shift, right? It seeks to end the needless homelessness that results from people leaving public institutions. They are seeing this, folks, as the low-hanging fruit. Collaboration without consequence, though, is simply bureaucracy. So they need to tie funding to measurable outcomes. This DTC has got to transition from a general duty to refer into a prevention mandate with quantifiable targets. The current national plan sets specific goals: halve the number of people who become homeless on their first night out of prison, and ensuring no eligible person is discharged to the street after a hospital stay. What about financial accountability? Well, local authorities receiving the homelessness prevention grant and other related funding have got to demonstrate progress against specific measurable outcomes, right? Failure by partner agencies to meet DTC targets, if the prison system miss it or the health trusts miss it, there must be corrective action. There must be a reallocation of targeted prevention funds. This mirrors the systems-wide evaluation research, which explores the drivers of homelessness and identifies where interventions can have the greatest impact. A failure to enforce accountability simply sustains the current pattern where the taxpayer is paying the price of failure or the crisis accelerates. So that tripartite prescription provides the necessary fiscal stability, catalyses the required structural supply, and enforces the preventative discipline needed to dismantle the expensive and devastating social failure we currently face. It requires a brave shift from mitigating the crisis' symptoms to addressing its deep-seated economic and systemic root causes. Staggering 2.8 billion taxpayer expenditure that was last fiscal year 24-25 is not just a cost, it's a definitive measure of systemic failure. Costs are skyrocketing. Financial hemorrhage presents a profound moral and financial investment opportunity, and we need to bring those together. We've got to recognise that every pound we spend on short-term, high-cost emergency shelter is unproductive. It buys temporary space, it doesn't buy stability, perpetuates a crisis where a family is being made homeless or threatened with homelessness every 5 minutes. It isn't ending anytime soon under the current plans and structure. So what's the investment opportunity? This is the core argument of a sensible macroeconomist the Treasury might listen to, right? Is ending the cost of crisis cycle, achieve it by converting crisis-driven revenue expenditure into long-term capital investment. The government has already recognised the need for major capital investment, committing that 39 billion. It's the biggest boost to social and affordable housing in a generation. However, the urgency dictates that we must accelerate this by leveraging the immediate, enormous and recurring stream of TA funding. If you could just use a fraction of the 2.8 billion and rising was redirected into long-term institutional affordable housing finance, we could get multi-fold returns from that. A fiscal dividend, right? Redirecting that high-cost short-term rental payment, providing guaranteed stable funding for the construction and acquisition of permanent, genuinely affordable homes. Every completed unit reduces the demand on the statutory system, and that directly curtails the need for that £950 million local authority housing fund dedicated to emergency homes. This transforms a continuous high-rate revenue drain into a productive, depreciable assets. What about superior social return? Ending that reliance on high-cost, poor quality emergency mitigates the devastating social impacts observed in crisis conditions. Hidden homelessness shows precarious and transitory living situations significantly harm mental health, physical health, and sleep. 81% of people suffer with sleep problems in temporary homeless situations. So if we had some stable, permanent homes, we could break that cycle of complexity, dependence, and trauma that results in long-term public sector burdens across health, social care, and justice systems, where the government's own linked data research is seeking to understand more. What about if we end policy negligence? Well, this redirective strategy shifts the primary focus from managing the failure, the 2.8 billion TA bill, to securing success, which is measured by permanent affordable housing stock. It's the only economically rational way to sustain the ambition of this national plan to end homelessness, which aims to ensure homelessness is a rare, brief, and not repeated. I mean, let's hope so, right? That would be great to see. I don't have a lot of faith, as you can probably tell. But in essence, if we continue spending this 2.8 billion on temporary fixes every year, it's just financially irresponsible. It funds the problem, not the solution. By reallocating this capital, we purchase not just houses, but long-term social stability, health improvement, and a reduced future burden on the state. The ultimate fiscal dividend that ends the crisis once and for all. That overarching message this week, peeling back the layers of geopolitical friction, domestic protectionism, and UK economic gloom, is simple. The professional investor is currently standing in a field of mispriced risk, armed with the knowledge that the structural failure of the housing market guarantees an upward trajectory for prices and rents in the medium term. Let's get the finance noise out of the way first. Weak growth figures, services contracting at massive 0.3% in October, GDP falling for 4 consecutive months. The doves will have their day, folks. I'm still anticipating these 3 base rate cuts between now and Q3 next year. But don't just assume that easier monetary policy means immediate mortgage rate relief. I don't think the 5-year rate is going to move much at all, a small fraction of a percent. The current basis point discount is likely to decay, the discount between the gilt and the swap, that is. The long-term gilt yield still confirmed there is no confidence in the long-term UK economy, so the instruction remains. Do not sit waiting for rates to get better. Today's rates are pretty fair and reflect all the things we've been saying today. Lock in that cost of debt now, set, forget, move on to the next project. Now to the core opportunity. The RICS residential market report is thin gruel, designed to generate gloom, weakest demand in 2 years, agreed sales languishing, and a national price balance of minus 16% from the RICS survey. The amateur sees the crash, the professional sees the pause. Temporary psychological tax, driven by budget uncertainty primarily, created a window with thin competition, 32% down in terms of new buyer inquiries according to the balance figures from the RICS, motivated vendors. Crucially, data shows sellers are adjusting, with the price gap between listings and agreed sales narrowing massively from that anomalous 29.3% we saw the week before to 11.8%. Your play must be to exploit these affordability-driven transactions now, buying value while ignoring the noise, before the inevitable snapback predicted by the surveyors, who forecast a plus 24% price balance over the next 12 months. The strategic investor has also got to position themselves against the catastrophic social failure of the PRS. The exodus of landlords spooked by fiscal burdens and the Renters' Rights Act is contracting supply. This is driving statutory homelessness, confirmed by the horrifying statistic that a family is being made homeless or being threatened with homelessness every 5 minutes. Taxpayers are footing a crippling 2.8 billion bill annually for temporary accommodation, the ultimate price of systemic failure. And like I said, I think we'll see that top 3 billion next year. This colossal failure does create these acute investment opportunities, particularly in the southeast. London is actively hemorrhaging value, minus 44% on the balance, due to the high valuation council tax surcharge or the mansion tax, which is forcing sell-offs, we're told. London has seen a 9% increase in stock, and 31%, remember, of those homes on sale for Zoopla were formerly rental stock in London. The amateur landlords selling up do not have a great handle on the market. Your objective is to become the institutional-minded capital that acquires this distressed rental stock in the capital and surrounding areas. Alternatively, exploit the affordability ceiling by focusing on regions where rent growth remains strong. Remember, North East up 4.5% year on year, North West up 3.2% year on year, according to Zoopla. Areas are completely oblivious to the carnage in the South East. It's your choice. So this government's £3.5 billion national plan around homelessness, it's a high-cost crisis management strategy. It's not a structural solution, and until they fix that core supply deficit, the market will remain coiled for recovery. You have to buy value, you have to add value, and you have to manage the risk. This brief period of vendor motivation and depressed sentiment is the time to secure stock while the herd is paralysed by fear. The long-term trajectory remains upward because the structural constraints have not changed. Continuing to sit on your hands while the government spends 2.8 billion a year managing failure is an economically irrational choice. So as I draw this week to a close, the next property business workshop is filling up. We've only got 5 days left, as I'm saying this, before the end of the super early bird ticket sales. We have got a link in the comments. What will we be doing? We'll be starting the year with a bang, discussing strategic planning. How do you make the most of the next 12 months? And then some of our own methods and takes on productivity and time management alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping and group accounting. This is about measuring asset performance. It's not how to use zero, but how to make the most out of financial information. What should you be seeing monthly, and how should you interpret it properly and use it strategically to grow your business safely but quickly? Super early bird tickets are available for a couple more weeks with a genuine 20+% discount off the face value. As always, we have real life case studies about our own experiences and close with our no holds barred Q&A. Have you got something individual to consider? Well, get a VIP ticket and join us for dinner, a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. It's the best way, the VIP ticket, to get a substantial conversation with myself, Rod and other experienced property business people. So join us Thursday the 22nd of January 2026 in central London, tinyurl.com/PBWNINE. Hope to see you there. But above all, please remember, keep calm, always listen to the supplement and carry on. There will be opportunities abound this coming year and towards 2030 and beyond. We have a landscape set for a surefire bull run. Sure, it's going to be slowish, take a little while longer to get off the ground. It's taken longer than I thought it would already. But the amount of stock around is still keeping things a little bit suppressed at the moment. But if we stop putting taxes up and we just have some stability in the marketplace for a couple of years, the market's improving slowly, and then it'll be a case, in my opinion, of here we go. Thank you for listening.